The survey shows that on average, the estimated annual cost of disharmony is nearly $100 million.
Then that's also comes to your KPIs. Are you attracting more customers? Are you the best bank to offer that digital experience? Is the consumer feeling safe and more secure? There's many KPIs, both internal and external, in terms of value add, customer base. But the key one, keeping data safe to not getting hacked and keeping reputation high is key. I mean, data's hugely important. It's the liquid gold of our market now.
Welcome to the Rate of Flow podcast. Global firms say that they're leaking almost $100 million annually to fraud, cyber threats, and plain old inefficiency. Andrew Murray from FIS joins us to unpack fresh data on where the biggest snags really sit, how money in motion became the noisy middle child of the money lifecycle, and what bold moves in tech, process, and mindset can finally bring harmony back. Based off research from the Harmony Gap report from FIS. Andrew Murray leads FIS's International Banking and Payments Growth Office, driving the expansion of banking, payments, and treasury solutions outside North America. With 25 plus years experience in financial services, he brings a deep wealth of knowledge in capital markets, treasury, and banking. Andrew, it's great to have you here on the Rate of Flow podcast. To start things off, you're focused on payments. When is the last time that you personally have experienced a payment going sideways, whether it's paying a contractor or tuition?
Well, firstly, thank you for having me. Similar to yourself, I started off in banking. So I kind of go back to a large payment would always go wrong on a bank holiday or a long weekend where you have to wait over that long weekend to get the money back and think about use of funds and charges on interest and sit there sweating to get that back. Personally, there was a big change between, I started off in the UK. I've moved to Singapore recently. There was a big change between cash and the trust in, especially in building work, as you mentioned, it would be pay me cash and I want it all up front, or no, here's half and half. The big move now is really with the trust in instant payments. Pay me across my bank account, pay me 50% and 50%. So I wouldn't say necessarily gone wrong, but I see that big shift in personal payments and trust on both sides of the consumer, the payer, plus the receiver as builders and anything else you need done as work.
The UK was one of the first places to implement faster payments nearly 20 years ago, I guess, which seems amazing. And now you've recently moved to Singapore. What changes in habits or attitudes towards payments do you see between the two?
It feels like it's always been there. Probably before the smartphone, we had instant payments being used and open banking was seemed to always be there now in the UK. Obviously, moving to Singapore, which is a fantastic country and loving it here. But QR code is still very prevalent here. That's probably less seen in other parts of Europe and the UK. But in terms of things like pay now and instant payments, it's certainly becoming more prevalent and people moving away from necessarily true card issuance and into instant payment of movement of cash.
It's become the new normal, I guess.
It seems that way people are trusting. Going back to the UK, my daughter, if I can just tell a little bit of a story, my daughter, she just started a part-time job and she was at front of a pharmacy shop and everybody came in and would pay for their purchase and would tap and she was great, tell them the amount. This was a shock to me, and this is a bit more Gen Z, but the first person who came in and said, okay, that will be £4.95, and they handed her a piece of paper, which was a £5 note, and she had to open the till, and there was just these coins in front of her, and it was a shock of, I know money, and I can do maths, and she's doing her A-levels, so she's extremely smart, but it was a shock of, what are these things? What are these coins? So I think from a Gen Z, and as we look at the kind of the motion of money through, it really is a digital movement of money rather than a physical thing that people will hold now.
Yeah, it's a complete mindset change. It reminds me, we just came back from a trip and watching my son pick up the phone in the hotel, he holds it backwards because he has no concept of what a phone is. He's just used to a mobile phone. Recently, FIS has published this report about disharmony in payments and financial markets in general, or financial industry in general. The survey shows that on average, the estimated annual cost of disharmony is nearly $100 million. Andrew, when it was published, was there a number in the report that made you go, wait, that can't be right? Let's double check that.
Yeah, I mean, a large percentage is really around the friction at the fraud and risk side of the report. The sheer amount of loss, I guess, at that point is huge. But as we just talked about with the speed, instant payments, digital movements, people really making those payments on their phone, expecting a message to pop up to say it was me, tick, done. That instantness, that's where the leakage is happening, and then that's where the biggest friction is seen. So that was a not necessarily unsurprising, but the sheer, being nearly 35% of that 100 million loss is key.
When you speak to companies, your clients and company boards, do you feel like they have a good view of what these costs are and understand them, or are they just getting their heads around it?
It varies, right? It depends on the organization, but obviously the report was over 1,000 senior execs. Were interviewed on the report of all large size organizations across the 3 geographies. So we did it. It wasn't just one country, and let's get the view. It was largely Singapore, UK, and the US. So I think the view of where the money leakage is happening is seen in some parts. But these banks and all institutions are big, right? And they have, if you think of where the money, where the money's at rest, where the money is, in motion, and where it's, at work. That's a lot of organizations, a lot of departments to really understand where that money leakage is happening. So I'd say it varied from institution to institution, as the survey kind of shows.
What did you feel that they were glossing over or not paying enough attention to in terms of these kind of either hidden or not hidden costs?
I don't know if it was, I wouldn't say glossing over, but I think it's how do you prioritize? We all know, fraud and cybersecurity is key, and you can't avoid that, and that has to be, but it's at the same time as providing real-time, always-on services to consumers, to you and I. If we go onto our app and the app's down, we're hugely frustrated, right? So you've got to have always-on as well as being able to deploy pretty much in real time with always-on, always-up services, but to keep ahead of a fast-moving market.
Yeah, that's a definite challenge. I mean, in terms of that 100 million, the way it broke down was about 32% was focused on cyber, 22% on fraud, and about 15% on regulatory challenges. The tech giants seem to say that fraud is still their number one issue, unlike banks, where cyber is the biggest issue that they're seeing. Does that map out well with what your experience is in working with clients in the financial institutions?
Yeah, I mean, speaking to some of the CIOs on various visits, there's thousands of hit on potential cyber attacks every day, right? And again, keeping the cyber threats away, keeping the fraudsters away. People see their bank account almost like their heartbeat. You go to the gym to keep your heart healthy. People view their bank account in the same way. Your pension pot, your investments, your liquidity that you need on a daily basis has to always be on. So you want your money to be safe. You're expecting your bank or your fintech or your institution to be keeping that money safe and secure. So the investment in fraud and cyber has to be there, but it's keeping those things in motion at the same time as kind of implement at real time as well.
How does that, I mean, just going back to you personally, I mean, how do you feel about that when you look at where you have your money? Do considerations around a tech platform versus a bank, do those come into your mind in terms of considerations about where to put your money?
Yeah, it's a bit like, I guess it's a bit like being a doctor, right? If you can sometimes know too much, whereas an ache and pain you can just ignore if you don't know. But yeah, absolutely. If how much money am I going to invest in a certain institution? How much is safe by the central bank or the regulator? Do I want to put too much in one pot? How much liquidity do I need versus am I going to invest in assets versus exchanges? As the report shows, this is probably one of the toughest times for executives to be running companies and making those decisions. It's probably one of the most volatile markets, post-World Wars, right? It's if you think of interest rates, some countries are making extremely low. Switzerland's gone to zero. The UK has just held at 4.25%. So it's decisions to make of and it's a global world. You can move money very easily. As I say, moving from UK to Singapore, it wasn't, obviously I've set up my bank account here in Singapore, but it's moving of money or using my Fintech card. I can walk into any hawker center and pay. So my investments and kind of that money at work, as we call it, has become easier because of technology. But I also have a bit of anxiety about, is it still there? Whereas, has somebody got into that account? Update my passwords to make sure nobody can get into that account on a frequent basis. So, as I say, sometimes it's good to know and have the knowledge, and sometimes maybe sleep easier without it.
Yes, it'd be a little bit easier to be ignorant about some of the challenges out there. You mentioned regulators and cross-border payments. What jurisdictional rule secretly adds the most days to a cross-border payment? What is out there today that many people don't know about, that is really slowing things down in cross-border payments and causing that friction that we talked about?
It is exactly it's the friction, and again, being in the business, you need to know where that payment's being originated, who the originator is. Just because you're paying family, it doesn't mean somebody hasn't got to check that and make sure that is legitimate and it's come from the right source. So, if we can make both the KYC, the AML processes more smoother, I think that's going to remove some of the friction from cross-border, as well as some of the harmony in the sharing of data across countries and jurisdictions to allow payments to flow quicker and easier. And I think ISO 20022 will allow for some of that, because obviously some of the formatting of messages today are the same messages I was using nearly 30 years ago to input to make payments. So you're a little bit restricted on, tell me more about Andrew Murray and where he is. He was in the UK and now he's in Singapore. Is that right? So I think allowing for the ease of data and cross jurisdiction and also bringing down that cost will make less friction on cross-border payments.
Do you feel like, you mentioned ISO 20022, which has obviously been a topic of discussion for many years and now kind of hitting full gas and moving forward in many jurisdictions. Do you see banks and financial institutions looking at that as more of a value add, or are they still stuck in the mindset of, we have to do this, so let's just do it and get it over with?
I think it started initially with, do we have to do this, and what value are we going to get from it? I think now, if you look at everything we talked about, but the ecosystem of payments, better reconciliation, quicker investigations. I talked about my scenario of an over the weekend, and sending out a X99 message to try or a 92 message to get that back. And now it should be more real time and easier to go back to the institution and get that money back. So I think it's now seen as a value add across the ecosystem. Again, being able to format that data and have more data fields that are relevant should remove some of that friction and should be a good thing.
One of the points that came up in the report was that 51% of executives said that the worst friction shows up en route. You talked a little bit about how ISO 20022, the added fields, can help with that. But why is that middle mile still a gravel road instead of a superhighway?
So, obviously, the ISO has been delayed a few times, right? So bringing that in. But as we look at that money in motion, it's got to continue, right? There's never a day that money stops moving. So you've got to think of the whole, the size and the heartbeat in some of the institutions where the payments infrastructure is, all the way down to the digital experience, large corporates moving large sums of money versus to you and I moving that money on paying our bills or fees or whatever. So it is a fast evolving market. It probably feels to the outside that it's slow moving, but the investment in that space and the speed it is moving shouldn't be underestimated.
One of the obviously trends that we're seeing even just over the past few months has been around stablecoins, and obviously the opportunity for that. So we've seen multiple different funding rounds. We've seen Circle go IPO and high valuations in the US. What role do you feel that stablecoins have in that cross-border element, or in payments in general? Maybe we can talk about cross-border, and then maybe talk a little bit about how that fits into FIS's strategy and how you're looking at stablecoins and integrating that into some of the platforms that you provide to customers.
It's a great question, and it's one that if we look at some of the other assets that have been been introduced. Can stable coins be used for things like collateral management? Can they be put up as collateral? Is it pegged to currency? Is it pegged to central bank? There's a lot of questions still to be answered. In terms of that moving of money from an FIS standpoint, we'll be working very closely with customers of where does that fit in our it's really in the money in motion through how do we make the payments, how do we do all of the kind of the fraudulent checks, etc. with our customers, as well as on our money at work. Where will this be invested? Where will this be used by from our asset manager clients through to our broker dealer clients? But the work is underway on how that would move through our money lifecycle, how we support it in systems. But we've done that with things like crypto. We've done that with new asset classes that have come out in the market for trading. So it's something we're always keeping ahead of. Thought leadership with clients, and we'll be there ready to support as it kind of as it takes off.
Overhyped or underhyped?
To be seen. I don't think it's overhyped because again, I think it's a digital type currency. And as I talked about my daughter, she thinks everything's digital anyway, and everything lives on a phone. So I don't think it's overhyped. I think it's still with all of the priorities that we just talked about. If I was running the bank and 32 million was being lost on my cyber or fraud, I'd probably be focusing there first.
Yeah, in many ways, it's just another asset class for people to trade. Beyond stablecoins, what other technologies excite you about the payment space? Obviously AI, and we've had many conversations about that, but what excites you? What do you think is going to really change the way that we look at payments in 5 years?
You took AI away from me, so I can't use that one. But I do think, again, I come back to the friction, and I don't think you can get away from AI in terms of reducing the number of false positives of why is my payment being held up? First time I'm making a payment, I'm overseas on a holiday and it's being held up. Why? If that can be speeder and quicker and less friction, and that's through AI, then I think that's a great thing. I think the view of instant payments, again, being able to move money around cross-border. As a consumer, the world has become smaller, so I want to be able to travel more, and I'm going to be in a foreign country. The ability to just be able to move my Singapore dollars into Hong Kong dollars, at a tap of a button, and everything already knows where I am, and that's common for Andrew Murray to do. And that technology that sits behind it, and some of that will still be driven by AI and machine learning and knowing my patterns. So I think that's, I don't think you can move too far away from where AI is, and I don't think that's overhyped. I don't think we can move too far away from that.
Do you think underhyped?
I think it may be underhyped. There's a lot of use cases out there. How do you use those and turn them into real production-based factual? Again, I come back from 25 years of my 30 years in capital markets. If you think about the risk models that are run on a desk, a quant's desk running models on what's going to happen in the future, the algorithms and the computation that goes into that, that's almost AI is already kind of there and been there in capital markets. How do you now take that and move it into a more of a consumer usage of, okay, thinking about the person, what are their trading patterns, what are their investment patterns, when do we think they want to retire and what do they need, and kind of using it a lot more to know the person and then feed that data to them of how much liquidity you might need for for school fees, for upcoming car servicing, whatever it may be, but it's going to be feeding that information to you on upcoming payments you hadn't thought about. And that's people outside of the market who just every day need help with so be more inclusion and also more education on think about the future of finances. And I think AI can help a lot there.
Do you feel that consumers, when you think about AI, that can automate many things for us, obviously within our financial space? You kind of hinted at this. My personal feel is I like to see the money move, so I know and I have a certain amount of comfort with that. That might just be an age thing. Maybe the millennials don't care about that so much. But do you think we'll get to a point where people are happy with AI just taking care of everything? So you just go to Starbucks, you tap, your bills are paid in the background, your mortgage payment goes out, your salary is allocated 10% to your pension and 80% to whatever else?
I think if you think about those use cases you just talked about, a lot of that happens anyway. You go back in to make, even if you manually go in to make a payment, it says, hey, you've paid this person before, this is how much you paid. Do you want to reuse? Is it a trusted person? And you click yes. That's already, doing that verification for you and suggesting, as I say, a lot of, again, our portfolio managers are making using algorithms to decide the kind of risk factors and where you should be, and you're just saying yes, I'm okay with that. So it's already happening kind of downstream a bit, and you're taking that human step. I think we will see in the younger generation. It will just be I trust that the algorithm's right, unless it's got a view. Obviously, as we talk about some of the friction and challenges in the market at the moment, right? Can it know that certain events in the market are going to happen and cause huge volatility? Is the right time to, if everything moves towards automating and everything's perfect and it buys at the right time, then there's probably no volatility in the market and everyone's at the same. So I think there will be a trust in it, but there'll still be a room for the smart human elements to it as well, of knowing the market and things that are coming up.
Right. That element of people is obviously important in banks. I mean, one of the challenges with AI is that we lose sight of that cultural element of things within organizations. One of the other stats that came out of the report was 64% of executives beefed up cyber defense, yet only 53% trained staff regularly. Do you think when we look at those cultural elements within an organization that banks are focused on the right things, or are they too reliant on technology to make those changes and fixes in a lot of the friction?
Yeah, it was again 53% are doing the training, right? Which leaves nearly half aren't doing the training, and the biggest weakness in that line of defense is the person that clicks the link that says it's sent within the company and the address is different, or it's a phishing. So I think that training needs to be stepped up, will be stepped up as people start to see, okay, it's not just a technology play, it's got to be the people of potentially the weakest link there as a first line of defense, as well as first line of defense, but also first line of weakness if too familiar with, okay, that looks like an HR email, it looks like a payroll email, click on it. So I think those training will be more frequent, and test to make sure people are staying alert.
Do you feel that training, I mean, when you look at all of the non-tech fixes that you can have for some of the frictions that we're facing in payments, do you feel that training is the biggest ROI, or what do you feel would be the biggest non-tech fix that would give you an ROI? I guess
as I say, the biggest weakness is going to be human error, and it always has been. As we were talking about payments earlier, that's human keying in of data, and the phishing, the scamming gets more sophisticated. It looks almost like it's from your so certainly education and making people more aware, your employees more aware, and be more vigilant is going to give a great return on investment. And outside of tech, I think that probably is. I'm trying to think. It all comes back to technology and being smarter and trying to stop that before it gets in, before it comes into the inbox. But yeah, I think probably training, awareness, making sure your staff are more vigilant and can spot it.
And where do you see as the priorities? So say you were a CIO, Chief Information Officer at one of your clients, and you had $100 million budget. How would you split that across people, process, and tech to address some of these challenges? What percentages would you look at for?
I'm probably slightly biased, and I'd put it a big chunk. I would put it into largely into technology. I mean, it's a great point as well of choosing the right partner for technology. I think ensuring and there's many parts. It's not technology is one part, the provider of things like the software and the running of the service. Where's that hosted? Have you got the right partner that's also investing heavily in cybersecurity? not just the smartest tech at the front end, but as really investing in the right things that align to your company's strategy. So I would put a large part on probably my 60 to 70 million would be going on technology, including getting ahead of those threats and attacks. As we talked about, the education of the staff, so they're the ones who are still at the time using that system. So and then I think it's probably some innovation of how do we keep ahead of it. So you're investing to run the bank or run your institution, make sure the people are trained and are aware and are vigilant. But how do you keep ahead of that? So some innovation budget, which I think sometimes is so busy keeping lights on and running the institution. Some of that innovation gets dropped out of the budget to kind of put back into to run the bank.
So obviously, a lot of the initiatives that you mentioned will help improve the environment within the organizations, but measuring that improvement is really critical. You can obviously look at things like the number of hack attempts you've had and the number of times you have been hacked, hopefully zero. But what are some of the other KPIs that banks either are looking at and having good success looking at or should be looking at?
Yeah, I mean, the report shows obviously 100 million is sounds a lot, right? And it is across 1,000 organizations, on average, the 100 million. But I think the KPIs, hopefully you haven't been hacked. It's how many times you're defending that hack. Are you reducing the number of fraud attempts? How much are you having to pay back through fraudulent activity? Are you making savings and reducing that level of fraud? It's never going to be zero. But then that's also comes to your KPIs. Are you attracting more customers? Are you the best bank to offer that digital experience? Is the consumer feeling safe and more secure? So I think there's many KPIs, both internal and external, in terms of value add customer base that will be tracked as a CIO. But then the value add you can give back to customers. Are you getting to new products to market quicker? Are you bringing on the customer base bigger? So there's many ways, obviously, as KPIs to view the success. But the key one that I think probably keeps, if I was CIO of that institution, not getting hacked and not keeping data safe. I mean, data's obviously hugely important. It's the liquid gold really of our market now. Keeping that secure and keeping the reputation high is key.
Yeah, you point to some good points. I think with my experience of being a CIO at Citigroup many years ago, at Citigroup Portugal, there was so much focus on the operational activities, but there was never a focus on how can we delight our customers or how can we bring other products to market. So I think you're commenting on these are the core KPIs you need to have. But for many, I think on the technology side, we lose sight of some of those business-focused KPIs that should also be part of our remit to ensure that we're staying ahead and growing our customer base and increasing share of wallet, et cetera.
Yeah, and it's interesting. Your background, I guess, is on the technology side. I came from more of the business operations side. So I always think of, how do we remove the friction? How do we get straight through processing? How do we make it quicker and easier for the clients at the end, whether that's my corporate, my consumer clients, or even my trading desk as if I was in operations, and then work very closely with technology of how do we now implement and make sure this is up and running, secure, and delivered on time.
Yeah. So the next section is the lightning round section, where I'm going to ask you some very short questions and just short responses about whether you think this is myth or reality. Yeah. First one is, real-time rails will kill correspondent banking.
Myth.
Why?
I think they can coexist, and I think they will coexist for a considerable amount of time.
Number 2, generative AI eclipses rules engines in fraud by 2027.
Myth on the timing. I think 2027 is probably too aggressive with everything else is going on in the market that we talked about during the interview. So I think you're partly right, but I think myth on the date.
So it's further out?
Yeah. 2030? Potentially.
Okay. Regulation is now a bigger drag than legacy tech.
True. Yeah, I think again, all the things, regulation, the heartbeat of financial has to have key regulatory framework in place, and it might feel like a drag, but it has to be there. So we have to keep ahead of all of those.
CFOs will track disharmony cost alongside EBITDA by 2030.
True. I think CFO will be closer with chief digital officer, a chief admin, AI officer, to understand, can the benefit of the cost of investing in these things bring cost down and improve EBITDA.
Interesting. Yeah, it would be good to see them track that in a more comprehensive way. So on the last section, I just want to focus on kind of looking forward into the future. The report obviously is around disharmony in the money lifecycle. Fast forward to 2030, describe a truly harmonious money lifecycle. What won't irritate us anymore in 2030?
So I think if we think of where we've gone in the last 10 years, even the last 5 years, I guess but the whole flow of the life cycle, the money at rest, my deposits, my bank accounts, I can see them, in real time. I can go into one digital app and I want to be able to then move in harmony my payment across, without, downtime, without the payment being stopped because it doesn't know who I am or it's asking more questions on KYC. So I want to be able to make that payment, but I want to be able to trust that it's me making the payment. So I think the security and fraud will be a lot more seamless, but actually more powerful by 2030. And then also in the same place, I want my money to be at work. I don't want the money that I want to know that I've got enough money at rest to cover everything I need to do, but I want it to be working and giving me a good return. And leading towards closer to my retirement date, as that money's sitting there, and that's all happening within the same place. Or if it's not in the same app, it's ability to be able to go outside with things like open banking. I can move that much quicker and make my investment. So I think it becomes a much more seamless, frictionless experience for the end users.
Harmonious experience. Yes,
very harmonious.
That's from my days in China, of course. Harmony was a big part of listener homework. So tomorrow at 9 a.m., somebody who's listening to this today, whatever day that might be, what's the first thing that you would recommend that they do? Whether they're a technologist or a business side within the organization, for a banker, what's the one thing that they need to be doing tomorrow that they're not doing today?
Work closer. I think collaborate with if you're technology or your business, the other way around. Bring your partners, your system providers closer into your inner workings. I think the days of there's a vendor and then there's the bank and the strategy, that's moving to be more in harmony. But I would wake up tomorrow and I would bring them closer in, treat them as a trusted partner. You understand their roadmap and strategy and what they're doing around all the things we talked about that are costing you money, so you can reduce that 100 million gap, but treat them as a real partner and understand their investment, their strategy, and where they're investing in innovation.
Last question. A case study from your experience, from clients who can remain unnamed, a positive or negative that you've seen over the past couple of months that was kind of too fresh to get into the report, but something that you've seen in the marketplace that really surprised you positively or negatively from a client?
There's obviously quite a few that I would pick on, but I think probably around the cross-border payments in the APAC region, where the customer I've got in mind, I won't call out, but are supporting their large corporates around the globe, and they've managed to dramatically reduce the cost of those transactions for their customers, through using, smart payment technology from our company. And they managed to do that in a rapid implementation timeframe by working closely to, take what's out the box and ready so they could get that to market quicker and stand it up to support their clients who wanted to move quickly around the globe with their payments.
Going back to that new normal, and this is what the expectation is from clients, right? The same tap that you get from your phone or your TikTok, you want that from your bank as well, even if you're a treasurer, I guess. Andrew, thank you so much for coming on the first Rate of Flow podcast. It was great to have you here and talk through all of these things. We'll include a link for the report in the podcast notes so people can take a look at that. But thank you.
I really appreciate you having me. Thank you very much.